It's been a light week for data. However, the Reserve Bank did release the minutes of its board meeting, hinting at the importance of the second quarter inflation data to be released this Wednesday. If the inflation print is low, like the last reading shown here in this chart, the consensus expectation of economists is that the RBA will lower the cash rate on the 2nd of August. In fact, it is widely believed that only an upside surprise on inflation data will keep the RBA sidelined. Based on the excess capacity in the labour market, an underlying inflation rate sitting below the bottom of the RBA's 2 to 3% target band, and forecast by the RBA to remain below the target band until the beginning of 2018, the financial markets are pricing in more than a 60% chance of a rate cut in August, from 1.75% to 1.5%. In international news, for a second consecutive time this year, the International Monetary Fund, better known as the IMF, made some small downward adjustments to its global growth projections. This chart shows the IMF's 3 scenarios for its global growth outlook: baseline, downside and severe. Baseline revisions expect the world economy to grow by 3.1% in 2016, down from 3.2%, and 3.4% in 2017, down from 3.5%. The IMF's global growth update was based on economic, political and institutional uncertainties emanating predominantly from Brexit concerns, the undercapitalisation of Italian and Portuguese banks, a disruptive deleveraging adjustment in China, a shift towards protectionist policies in advanced economies and heightened geopolitical tensions, evidenced through the failed Turkish military coup and the South China Sea dispute, just to name a few. In China, we expect the economy to continue to face renewed pressures in the second half of this year due to a housing downturn and slower consumer spending, and therefore expect Beijing to act by easing monetary policy again sooner rather than later. For Australia, the key concerns are a slowing Chinese economy. Expect further downside risks to our commodity prices as world supply hits the market and China slows. A weakening Australian dollar will be needed to help shield Australia from some of the effects of this slowdown. But that may not last if the recent strengthening in the Australian dollar is sustained. Until next time, that's the market update from Bendigo Bank.